Crude at 2011 highs. From New York City this morning, good morning, good morning. Futures positive, just about. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Strong words and unintended consequences. President Biden with a message for Russia's leader.
Putin is now isolated from the world more than he has ever been. And I'm taking robust action to make sure the pain of our sanctions is targeted at the Russian economy. Together, along with our allies, we are right now enforcing powerful economic sanctions. We're cutting off Russia's largest banks from the international financial system. We're choking Russia's access to technology that will sap its economic strength and weaken its military.
A growing list of sanctions intended to leave Russian energy untouched. But oil giants Shell, BP and now Exxon are leaving the country behind, and Russian crude sales are increasingly under an embargo in all but name. Bloomberg reporting the following, that on Tuesday, Trafigura Group, an oil trading giant, offered to sell a cargo of the nation's flagship crude for $18.60 a barrel less than an international benchmark. The deepest discount ever, but still drew no bids. Supply fears are driving crude to new highs and taking other commodities with them. European gas has surged and wheat has rallied through highs not seen since 2008. Our team coverage begins right now. Bloomberg's Anne-Marie down in D.C., Maria Tadeo in Brussels. Anne-Marie, through 110, how much of a problem is that?
It's a massive problem. When you look at WTI going through $110 a barrel, Jonathan, how does this trickle down to the American consumer as this administration tries to fight inflation? It's going to end up on the supply chain. It's going to end up at the gasoline pump. You mentioned wheat. That is going to be a global inflationary problem for food shortages and the likes. Jonathan, what we saw from this administration, the president reiterated it yesterday, 60 million barrels, 30 million coming from the United States in terms of the Strategic Petroleum Reserve. The issue is that would work if we lose, say, 2 million barrels off the market a day for a month. The issue right now, and you called it an embargo all in name, individuals are self-sanctioning. It is very difficult right now to try to get refiners, ships to process Russian oil.
Energy Aspects pointing out, AMH, that about 70% of Russian crude is now struggling to find buyers. When you speak to people in Washington, the energy experts, do they think this is something that gets ironed out in the coming days and weeks, or something we might have to live with?
Well, at the moment, Jonathan, they'll just remind you that energy trades are right now not under embargo. They're not sanctioned. They have these carve-outs for this reason exactly. They want to make sure that Russian oil maintains on the market because it is a global market, and they don't want to see the risk, the geopolitical price rising in the oil market. So right now, they're probably going to try to clarify what those carve-outs actually mean. The issue is people are self-sanctioning. They don't want to deal with what could potentially be toxic assets in Putin's Russia. Or potentially, the administration has said energy is on the table. So what if you decide to make a transaction in 2 weeks' time? Are you then going to have to lose it? It is just becoming too fluid of a situation, and no one wants to touch it.
This is theory meeting reality, and to your point, from Energy Aspects and Anne-Marie to send several ship owners reportedly unwilling to make bookings from the Baltic or Black Sea due to the lack of war insurance. This conversation's changed quickly. Maria Tadeo, the conversation on the ground in Ukraine changing quickly as well. What's your latest read on the current situation?
It is. And to Anne-Marie's point, we know that there will be a finance ministers meeting here in Brussels. And one of the debates and one of the talking points will be what to do with energy in Europe and what to do with sanctions. Is that the next frontier? And if it is, well, you can see why for consumers it's going to be problematic. And in fact, to me, it's very telling that we now hear from the German, the French, the Italian, the Spanish leadership say this war is going to go on for long and it will have repercussions. And we need to be aware that this will have an economic economic impact. Now, that is on the economy. When you look on the political front, Jonathan, we have reports suggesting that perhaps today the Russian and the Ukrainian delegation could meet again. Remember, they met on Monday. There was no conclusion from that meeting. It's unclear where they would meet. There were reports at one point suggesting that it could happen in Poland. We know the Ukrainians do not want to go to Belarus. They fear for their safety. They fear this is a trap. But the reality is, even if you get the two sides to agree on a location at time and they sit down, the problem is Vladimir Putin says, my goals here is to get rid of Zelensky, who is now an icon in Ukraine, to take the weapons away from Ukraine, which the Ukrainians say they are not going to do as long as the war is still happening. And then secondly, ditch that NATO and EU membership pledge. The problem is, of course, is that the Ukrainian government has already filed from EU membership yesterday, and they continue to say NATO at one point is going to have to help one way or another, whether that means shutting down the skies. Well, that's one option, and then potentially down the line accepting this membership from Ukraine. So even if they meet, they're so far away. It's very difficult to see at this point on day 7, with people being shelled on a daily basis, how they agree on a diplomatic solution going forward.
Maria, thank you. Maria Tadeo over in Brussels, and Marie down in DC. AMH will touch base a little bit later this hour. You're all familiar with this stat. Europe depends on Russia for about a quarter of its crude, a third of its natural gas. That gets tons of attention. This line doesn't get enough. Russia and Ukraine supply more than a quarter of the world wheat exports, 1/5 of corn sales, plus about 80% of sunflower and oil cargoes. What are the economic and political consequences of that worldwide? Let's get into that right now with Ironside's Barry Knapp, Invesco's Mo Haghbin, and Katy Kaminski of Alphasimplex. Katy, the consequences of crude through 110 for this market, what are they?
I mean, this is serious. We've seen a massive move, and all of these price increases are going to trickle down at some point. We already had a massive headwind of inflation on the commodity sector. This is really going to put even further pressure. And wheat is yet another asset where we've seen sort of massive movements in terms of price momentum. And all of this is just going to eventually create some challenges for other sectors of the economy. And it doesn't look like it's going to stop if this conflict is not going to be resolved in a steady fashion.
Well, Barry, when you have conversations about the resolution of this conflict, do any of you, your team, people you speak to, can you come up with an off-ramp for President Putin?
No, not really, John. It's hard to see how this resolves itself without, in a truly favorable way, without Putin somehow getting removed by the oligarchs. So that's highly speculative. I just don't see an easy off-ramp.
Well, Barry, if there's not an easy off-ramp, do you have to assume it gets worse before it gets better? If you assume it gets worse before it gets better, do you assume energy's on the table for sanctions? If you assume that, do you assume crude has to go higher?
Yes. Listen, there was always a fairly big imbalance in crude, and as Omicron faded, we still hadn't gotten jet fuel or jet demand back to where it had been. So there was a supply and demand imbalance. I've never been longer energy stocks in my life than I am now. And that whole process started a year ago. That imbalance has been building. We had a, sort of a flash sell-off back in October when Omicron took the headlines. But no, this is an ongoing problem. So then the question becomes, and it's a question you've been asking all morning, first of all, where do we get demand destruction? And I hear some estimates from fairly credible sources of 135 to 140 or so on crude before it really starts to impact consumption in the U.S. And then what do the stocks reflect? And I asked an old colleague of mine from Barclays about that yesterday, and he said for the E&P names, it's something like 65 or 70 is the embedded, or implicit price in U.S. E&P names. So, even if we were to get some sort of a resolution and, you had a sell-off in crude, the stocks are still attractive.
Well, in the meantime, we're seeing some of the big oil majors back away from Russia. BP, Shell, Exxon, now Trafigura reviewing options for its passive holding in an oil project in Russia as well. Mo Haghbin is just lining up to back away from Russia. In the meantime, crude is just backing up higher. 111 on Brent, 109 on WTI. We're off session highs. I'm trying to work through this, and Mo, help me with all of this. The commodity community now are telling me that we need to see demand destruction to rebalance this market. if that's what the commodity community is saying, on the equity side, do we need to assume that forecasts need to come down as well for earnings in America, worldwide?
Yeah, look, it's an interesting question, and I think, the humanitarian crisis on the ground is what we're watching first and foremost. But as we think about markets, commodities is an area that we're watching very closely, obviously with energy, but also with industrial metals, as well as agriculture, which, as you know, wheat and corn are big agriculture markets for both Russia and Ukraine. We don't necessarily think that the spillover effects of the equity market, at least at this point, is something that we're positioning for. We continue to be slightly overweight equity, although defensive equity. So we've kind of gone up in quality and low volatility and up in the market cap in the equity portfolio. And we ballast that with the long duration or, an overweight to duration on the long end of the curve. So today we are not really positioning for that spillover into the equity markets, John.
Katy, Citi just published this. I want to bring that to all three of you, and we can build on this through the programme. Citi and Andrew Hollenhorst say the following: we strongly disagree with yesterday's pricing out of rate hikes. To the contrary, we expect the most durable US economic implication of geopolitical tensions to be more inflationary pressure and consequently more aggressive monetary tightening. That from Citi in the last hour. Katy, do you agree with that?
Yes, I have to say that I do, because if you look at the mismatch, and if you look at the technical signals in terms of where we are with numbers and inflation so high and interest rates so low, there's going to be constant pressure on central bankers to tighten that gap. And what I think about this recent environment, what was really interesting is, yes, we saw bonds rally yesterday out of a pure risk-off trade. But the truth is, even if there's a risk-off trade on the table, who's going to want to hold bonds for long term if inflation is at 7 and could go higher now because we're going to have more supply problems? And energy is one of the core, at the core of our economy. So I think things are looking a little bit rough. And I think that the Fed is actually even a harder place than where they were before. And so I do believe that they will have to react. It may just not be as quickly, but they will have to do something at some point.
Chairman Powell coming up a little bit later. Futures right now at 0.4%. Katy, Barry, Mo going to be sticking with us. Let's get you some moves ahead of the opening bell. With that, here's Abby.
Morning, John. And sticking with the surge in commodities after the Bloomberg Commodity Index yesterday up the most since 2009. We're seeing that, as you are all talking about today, once again with oil at its highest level since 2011. And this is really showing up in the energy complex. ExxonMobil, Devon Energy, Schlumberger and Valero. So the entire spectrum just surging higher, up more than 1%. Really pretty incredible. And it's extending right into the metals, too. Aluminum at another all-time high. We have Freeport-McMoRan and other metal and miners. Steel stocks also surging. Really, this is the bullish part of this surge for the commodities. It's interesting, John, that 2009 buying, that was on green shoots, but today it's, of course, on these supply fears.
Abby, thank you. Coming up on this program, President Biden pulling the trigger on a second release of American crude.
The United States has worked with 30 other countries to release 60 million barrels of oil from reserves around the world. America will lead that effort.
And so far, it hasn't made much of a difference. That's next.
Invading a foreign country has cost around the world. Tonight, I can announce the United States has worked with 30 other countries to release 60 million barrels of oil from reserves around the world. We stand ready to do more if necessary, united with our allies.
Is it enough? OPEC Plus joins in, raising its production by 400,000 barrels a day. Those efforts doing little to cool prices, with crude surging past 110. Energy Aspects and Rita Sen said this is COVID in reverse. We can easily breach 150. We have genuinely never tested where prices need to be to really curtail global growth. Bloomberg's Will Kennedy joins us now. It's a conversation Amrita and myself had earlier this morning, Will. It's COVID in reverse. The reverse of spring 2020, when demand collapsed and the only way to balance the market breaching storage capacity was negative prices. Will, who are you speaking to right now about how high crude needs to go to destroy demand and rebalance this market?
What we have is a supply collapse. We have a supply collapse that is gathering pace in Russia, John. People do not want to buy Russian crude. They can't get to ships into Russia, even if they do. And traders are increasingly realizing that means that we have 5 million barrels a day of supply, which is in jeopardy unless something changes soon. So as you say, prices will go higher, and we're seeing that process today. The market is incredibly stretched. We're seeing that in the spreads between oil right now and oil for a couple of months in the future at extraordinary levels. And it doesn't seem that there's much to stop the market until, as you say, people stop consuming because it's too expensive. Where that is, well, we don't know yet.
And Rita said maybe 150, 170. We don't know because we've never tested the theory before. Well, the numbers that came out of Energy Aspects, about 70% of Russian crude is now struggling to find buyers. Is that a boycott, Will? Is that a misunderstanding or a lack of understanding about what the sanctions are? Well, the reason I ask those questions is because I'm trying to work out if that's a story that sticks or fades in the coming weeks.
It's a really good question. I think there are three things going on right now, John. Number one, although oil isn't sanctioned, people are afraid of falling foul of the financial sanctions and the banking sanctions, and there's a lot of effort by compliance departments to understand what they can and can't do in terms of moving money around to buy oil. There's a reluctance from banks, some for that reason, to finance these transactions. There's a reluctance of ship owners to go to Russian ports. And that's a big part of this problem. And finally, among many players, there's a moral revulsion, if you like, or a reputational worry about doing business with Russia. You put all those things together, and it's really shrunk the universe of buyers. Now, Amrita made this point in one of her notes, which is as we go forward, as some of those issues around what the sanctions actually are resolved, I think she expects quite reasonably that Asian buyers especially will start buying Urals Russian crude again because it's cheap and they need the oil. There's a huge demand for it. So I think it is bad right now, but it probably will abate somewhat over the coming weeks. But that said, even if it's only 30% of Russian oil that's not getting bought for all the reasons I said, that's still a massive hole in global supply that we need to fill, either through new supply from somewhere else or a reduction in demand, as you say.
A market thirsty for crude. Will, great work to you and the team. Tremendous work. Really enjoyed the reads over the last couple of weeks. That's the line from Energy Aspects. About 70% of Russian crude trade is frozen. They indicate that this will drop to less than 20% once sanctions details emerge. Katy, Kaminski, I want to come to you. We talked about higher crude. I want to understand how you push some of that, the dynamics in the crude market, the prospect of demand destruction through the bond market. The move we saw yesterday in European bonds, Katy, massive. The UK, Germany, the US too.
Yeah, I think that was a really difficult day for the bond markets, especially for those of us that are positioned short, that are anticipating rate rises at some point. But for me, it feels like a temporary reversal to a longer term trend. Yes, I do think central bankers are going to become a little bit more wishy-washy under the stress of the situation. But on the other hand, I do think that longer term, those are going to be the right positions to be in because inflation is coming in hotter. And it's not something that's going to get better from what's going on right now with oil. And, you know, in some sense, we just have to keep and hold out and wait. But it was a tough day yesterday for European debt.
This is the story of the moment. The bond market moving off the back of what's happening more broadly in the global economy because of what's happening in Ukraine. Mo, I've barely talked about the pandemic now for a week. Hardly talked about it. And just off the radar, every single day you see more restrictions being removed across America. And this headline just crossed from Dow Jones. China exploring an exit from the zero tolerance approach to COVID. Mo, we've almost forgotten the story of the last 2 years. How important is that headline to you?
Yeah, it's interesting. It's a little bit conflicting with what we know is going on in Hong Kong, where, you know, there has been talks of another lockdown, and I think cases there have been, unlike the rest of the world, increasing and being problematic. So I think the headline itself is very important if it's true. That said, we're still kind of dealing with another uncertainty that, isn't taking the headlines, but it's still in the background. And I think everyone is still watching that carefully as the dynamic can change quickly.
Barry Knapp, your take.
Well, I'm not surprised. It was absolutely incredibly inane policy. And there was always some expectation after the Olympics they would start backing away from that. Core goods prices are running at 11.7% year on year. They're likely to come down for sure. The issue, though, is we're moving from the first order effects of pandemic on inflation to the second order effects. And you can toss it, and really where I'm going with that is now housing is likely to be the big driver of inflation on, through the course of 2022. Medical care inflation is just rebounding. Education hasn't even begun yet. So you have all those effects. And then something else I wrote about this week, which central bankers are conditioned to dismiss, which is a greater probability of energy and commodity price pass-through. If we are truly going to a multipolar or deglobalized world, we could very easily go back to the 60s and 70s where energy prices did move in lockstep with service prices and goods prices, and we really had energy price pass-through. So, Larry Summers said it on your program a little bit earlier that the risk is the Fed and other central banks do too little, not too much. And this energy price and commodity price pass-through is just yet another example of that.
So let's revisit that in just a moment, Barry, because that final point you're making, I think, is critical. Mohammed made this yesterday. If a central bank loses policy flexibility, that's not a good thing. That's not a good thing at all. And we need to work out what it means for this market. Inflation due March 10th. The estimate so far for America, CPI, 7.8%. There's only 3 estimates in, but that's the survey so far, 7.8% from a previous read of 7.5. The conversation continues with Barry Knapp, Mo Haghbin and Katy Kaminski coming up in the morning calls. And later, from energy to technology, the list of corporations exiting Russia piling up. That conversation just around the corner from New York. This is Bloomberg. Five minutes away from the opening bell, the state of play as follows. Equities higher by 0.5%. No real drama here, up about 1/3 of 1% on the Nasdaq. In the commodity market, 2011 highs briefly. Very close to 114 for a moment on Brent. On crude right now, WTI 112.30 on Brent, WTI at 110.38. That's the price action. Let's get you some morning calls. Wolf Research downgrading Zoom video to peer perform, expecting a material deceleration in revenue growth. Goldman upgrading all states to a buy from a sell, seeing a more supportive environment with pandemic-related headwinds fading. And finally, Bernstein upgrading HP Enterprise to outperform, highlighting the stock's compelling valuation and strengthening demand trends. Coming up, Exxon, Apple, Nike, a long list of corporations abandoning Russia. That conversation just around the corner from New York. This is Bloomberg. "23 seconds away from the opening bell in New York City this morning. Good morning. This Wednesday morning, equities up 0.6%. Equities up on the Nasdaq 0.5%, on the Russell by 0.7%. A lift with crude very close to 2011 highs. That's your opening bell. Switch up the board and get to crude. We look like this on WTI. WTI right now on crude 109.77. Crude up by more than 6%. The high of the session 112.51 on Brent, very close to 114 a little bit earlier today. Euro dollar a break of 111 to the downside, a third straight day of euro weakness, 110.98, negative 0.2%. And yields higher, reversing some of yesterday's move, up by 6 basis points, approaching 180 at 178.72. That's the open behind us. 20 seconds in. Let's get you some movers. Here's Abby.
John, let's stick with that strong energy story because it is, of course, one of the top sectors on the day. The energy complex rallying with crude at these unbelievable levels on supply fears. We have the likes of ExxonMobil and ConocoPhillips and many other names sharply higher. But it's not just oil and crude, the energy complex that's rallying. It's also natural resources in general. Bayer up almost 4% in Europe and U.S. steel up 2.2%. So this theme continues. Now, we have an overall rebound, at least right now. Will it stick? But a piece of it, of course, is big tech, which yesterday was down sharply. Apple rallying today. Salesforce.com up even more, up 3.9% on a very strong quarter and an outlook that beat Wall Street. And then the banks yesterday really beaten down. JP Morgan Chase, the big banks up just slightly, but some of the regional banks, such as KeyCorp, up even more. But KeyCorp up 2.3% today. Yesterday, down more than 8% as yields were down. So let's see whether or not the recovery continues to take hold. But certainly stocks pretty strong right now, John.
Abby, thank you. Thank you very much. We've taken so much out of the front end of the curve Twos are back down to 143. On Friday, the high of the session, through 160. In fact, 20 basis points north of where we are now. We're up 8 basis points today. Jim Bullard of the St. Louis Fed just said this. Inflation is running well above the Fed's target. The situation calls for a rapid withdrawal of accommodation. Rapid, the word that he's using. Current policy is exacerbating the inflation problem. We must follow through on rate hikes and balance sheet runoff. 143 at the front end. You just wonder how much we need to build out the front end again, because over the last couple of weeks, we've taken it all the way back down on the belief that the situation in Ukraine is going to mean the Federal Reserve can't do as much as what this market thought the Federal Reserve would do maybe a couple of weeks ago. Chairman Powell later, he might not want to provide forecasts, but on March 16th, we'll get forecasts from this Federal Reserve. Elsewhere, we have seen a growing list of corporations pulling back and abandoning Russia. The latest automaker Ford suspending operations, writing in a statement, our current interest is entirely on the safety and well-being of people in Ukraine. We won't speculate on business implications. Joining us now for more, here's Katy.
Well, John, this list has become a laundry list. It is just company after company making these announcements. You have Ford, you also have the world's largest technology company, Apple, and the biggest athletic apparel maker, Nike, making these announcements yesterday, both of which are halting product sales in Russia after the invasion of Ukraine. This follows Hollywood studios like Walt Disney World pausing the release of new films in the region, and of course, announcements from a number of big oil players. Exxon now joining the likes of BP and Shell in exiting Russia, responding to the pressure on energy companies to do something in the face of the invasion of Ukraine and exiting investments at a likely cost of tens of billions of dollars to do so. And adding to the list earlier today, Trafigura reviewing options for its passive holding in Vostok Oil. It had bought a 10% stake in that Russian oil project that is controlled by Rosneft back in 2020. But the company now saying it immediately froze investments in Russia following news of the violence. What it really comes down to, Don, is this dual challenge of financial risk on the one hand and reputational risk on the other. But in regard to financial risk, we also have to take a look at some of these U.S. consumer goods companies that have heavy exposure in Russia. The likes of Coca-Cola, which gets 21% of its volume in Russia and Ukraine. McDonald's, 9% of revenue. AB InBev controls 14% of the market share in those markets. And at what point do they face significant risk because of the conflict and also because of the sanctions that are resulting from the conflict that could hit the Russian consumer, John?
Katy, thank you. It's a situation we need to follow for the banking industry here in the United States, not just worldwide. Citi kicking off its first Investor Day in nearly 5 years. James Fraser doing a ton with that bank very, very quickly. Bloomberg's Sonali Basak joining us now with an update. And Sonali, you're here and not there because nobody's there, right?
Yeah, they actually had to cancel the in-person event because some of the presenters had tested positive for COVID-19. Nonetheless, it is a huge moment for Jane Fraser, who off the bat had acknowledged the difficulties that the bank had faced and that they have not lived up to their full potential. If you take a look at Citigroup stock, not only has it underperformed its peers, John, it is the only bank among the major U.S. banks that is trading below its book value and meaningfully below its book value at 0.6% pretty much of its book value. So, a lot of troubles over there at Citigroup. In the first couple of months of Jane Fraser's tenure, she announced a lot of cuts. She announced that she would be stepping back from certain markets and certain businesses. Now she is giving a plan for growth. But what does a new normal look like for Citigroup here, even with expanding certain business lines and investing? 11 to 12% returns on tangible common equity is less than what it made last year. It is less than what they hoped for from their prior investor day, and it is less than what you'll see over at the major banks such as Morgan Stanley, Goldman Sachs, and JP Morgan that have announced plans of 17% or higher. So this is going to be the new normal for Citigroup while we look forward. I also, though, John, want to pivot a little bit and talk about Russia and Citigroup. Russia is only about $5.4 billion worth of country exposure, less than $10 billion in total exposure for Citigroup. But Citigroup is really a interesting example here of a big global bank in Russia. Remember, since 2014, when they first started reducing their exposure to Russia, the exposure is relatively unchanged from where it was back in 2014. The country exposure is less than 0.3% of the company's total, but Citigroup, like JP Morgan and many other banks, as global transaction banks, are now sitting there with work with the central government, trying to untangle themselves from any potential sanctions that might play out through SWIFT or with the central bank or the sovereign wealth fund or otherwise.
Some of the companies are just taking a stance. ING Group this morning over in the Netherlands, Sonali said this: we have decided not to do any new business with any Russian companies. Now, new, obviously, the operative word there, the important word. Have we seen any American bank on Wall Street take that stance?
Well, we have seen them step back over a number of years. We've seen banking leaders over the last couple of years, though not this year, take a strong vocal step back from doing any business with the Russian government. But with that said, remember, there's a joke on Wall Street that the big U.S. banks are semi-utilities here, and they move where the government goes. So until there are stronger sanctions, and until actually some of the sanctions that have already been announced are cleared up, it's going to be difficult to figure out how to entangle them from the Russian financial system.
We need to clear that up. Shonali, great work, as always. Shonali Basak on top of Wall Street, as you'd expect. So what have we got here? Early days of forced liquidations, potentially boycotts as well, companies stepping back for this perceived moral obligation that they're talking about as well. Mo Haghbin, the selling hasn't even started. BP wants to offload its Rosneft stake. Let's see if they can and for what price. I saw Roman Abramovich in the UK trying to sell Chelsea Football Club. Again, he's got a price, but he's got a target of the middle of this month. Let's see if he gets the number he'd like. Mo, it just seems to me that this is the start of a process. From the people that I speak to, knee-deep in emerging markets, that's what they keep telling me. It's the start of the process. We haven't seen all the moves yet. Would you agree?
Yeah, I think that's right. I mean, I think one of the things that is going to be important is the ability to transact, right? And as we know today, very difficult both on the equity side and the debt side to transact. So thinking about your investments in emerging markets, specifically Russia, and how do you actually manage that? I think one of the major things that would have to happen in order for that to clear up or for that to be more pronounced across kind of the asset management community would obviously be country inclusion in several of the indices. So until that gets sorted out and the markets open so that you can actually transact, you're basically sitting on your current position.
A lot of people looking to JP Morgan for some of those decisions to be made maybe soon. Mo, the framework that you've got at the moment, just positioned for a slowdown cross-asset through the portfolio. Is that the approach? Does that approach stick even with the dislocations we've seen over the last couple of weeks?
Yeah, look, I mean, that was the positioning before this invasion and war. So, we're sticking to that. And what's important about that is not only what we believe is kind of the environment in a slowdown for risk assets, right? Generally speaking, there's a convergence and there's very little dispersion around risk assets, but still positive in all cases. But what we do is we get defensive, right? So we've gotten defensive on the equity side. And as I mentioned earlier, and I mentioned on the last time I was on, we've had an overweight to duration, right, in the long end of the curve. And we continue to believe that the yield curve will flatten.
Invert by year end, Mo? Would you go that far?
I don't know if I'd go that far. I think we still have about a 75 basis point spread between 2s and 30s, but flattening, absolutely. We don't see that long end of the curve moving. It's anchored.
Katy, I get the feeling a lot of this resonates with you.
Yes. I mean, I think my challenge has been that we've been neutral to negative on equities to some degree because we tend to be a little bit on the faster end and more technical signal basis, but cross-asset signals have been very interesting to follow this year. We've seen a lot of pressure on fixed income. We've seen massive signals in commodities. And I think for the equity markets, you have to ask yourself, what looks good? Maybe the Fed being nicer or easier for a short period of time, but there's a lot of things that are going to have to be sorted out. So there's a lot of things that are kind of piled up against the equity markets. So I tend to be a little bit more concerned that this is not really the year of great equity returns yet, until I see some other indications.
Barry Knapp, the final word. Have you heard enough from enough bears to get bullish?
Oh, yeah. This was in our forecast. When the Fed starts normalizing policy, you get 10 to 12% corrections. Every business cycle since World War II, you had one of them. Last cycle, you had 8 of them. We expected this to be the first trade out of the gates in 2022. We've got it. We think we've had an appropriate adjustment to Fed policy normalization. The typical pattern is you'll recover. The market will trade in a range for a quarter or so, and then we'll be back on our way through the rest of the business cycle. So for me, this is a buying opportunity. When you get a chance to put money to work in the S&P anywhere around 4,200, you need to be doing it. You need to be getting into the reflationary sectors. We're moving towards deglobalization, a big capital spending boom, industrials. energy, materials, financials, all of those sectors. This is what investors should be doing into this week.
Barry, I've heard you say that a few times over the last 12 months. That's your big theme. Do you get the feeling what we've experienced in the last week just accelerates that then?
For sure. This is, again, this is what happens when the Fed starts normalizing policy. So we're going to get this risk off. We were always going to have a difficult environment in the first half of the year, but these are your best entry points for most investors. That obviously the recession-related low is a great entry point. Most people don't do it, but then if you think about the drawdown we had after QE1 in 2010 or QE2 in 2011, those are excellent entry points to put some serious capital to work. Sure, it's going to be a difficult environment as the Fed withdraws liquidity, but it's never terminal for the business cycle. And if Larry Summers is right, the Fed's going to do too little, not too much. Eventually, that'll catch up to him. But I don't think Jerome Powell's about to evolve into Paul Volcker anytime soon and overdo it and drive us into recession. That just doesn't make all that much sense at this stage. So equities are still a much better bet than fixed income, than long duration. In a lot of ways, we think this is going to look like the early 60s where bond returns are negative. The 60-40 model, although that wasn't really a thing back then, broke down. But equities can earn out pretty strong earnings growth because nominal GDP is likely to be much stronger than it was last cycle, which means stronger trend earnings growth.
Barry, good to catch up, buddy, as always. Barry Knapp, to Mo Haghbin, thank you, sir, and to Katy, Kaminski. Your equity market up 0.75%, 43.38 on the S&P, up about 32 points. Coming up, President Biden vowing to confront Russia over the invasion of Ukraine.
A Russian dictator invading a foreign country has cost around the world.
More on the President's State of the Union address next.
A Russian dictator invading a foreign country has cost around the world. And I'm taking robust action to make sure the pain of our sanctions is targeted at the Russian economy.
President Biden condemning Russia's Putin and meeting rare bipartisan approval. A different story for his domestic agenda, with Iowa Governor Kim Reynolds blasting the administration for surging prices.
They were warned that spending trillions would lead to soaring inflation. They were told that their anti-energy policies would send gas prices to new heights, but they plowed ahead anyway, raising the price at the pump by 50% and pushing inflation to a 40-year high.
Anne-Marie down in D.C. AMH, how well received has that message been in the last 12 hours?
Well, Jonathan, the start of the president's speech was really the centerpiece in the sense that this is where he was able to get bipartisan support. And we should note the Ukrainian ambassador to the United States, Oksana Markarova, really stole the show. Every single member of that chamber stood up and clapped for her. So this was really a pivotal moment of his speech, a speech that had to be reworked because obviously this president is now a 7th day in. He's a wartime president. He had to rework that speech. When it comes to the energy story, and you heard the Republican rebuttal, the president talked about the fact that he wants to lay harsh sanctions on President Putin in a moment that was almost ad-lib because it wasn't in the pre-prepared marks. He said he doesn't even know what's coming at him, but he wants to mitigate the issues at home. And right now, that is going to be the biggest challenge, Jonathan, because what we know is that corn, wheat, oil, nickel, that goes into EVs for batteries. All of these prices are surging.
It's really difficult. Credit to the administration. Didn't embarrass its allies abroad. Europe encouraged them to go further. I think for a lot of people, AMH, European allies have gone much further with sanctions than many people thought even just a week ago. Now it gets really difficult. How do you offset some of the pain caused by the sanctions introduced and the confusion, the unintended consequences of them too? We had the reserve release yesterday. Anne-Marie, we saw this story, this movie play out last year, at the back end of last year. Same story. Crude higher again. What can they do?
Yeah, and the last year when they first decided to tap the SPR under this administration, we saw potentially maybe 10 cents off of gallon of gasoline. I mean, that is the whole point of putting oil on the market, so you can mitigate the concerns on the gasoline pump. Jonathan, the question is, what do they do? It's very difficult. There are knock-on effects from these sanctions, even though they say that there are carve-outs for the energy trade. Potentially, I'm just thinking out loud here of something that could happen if there was an Iranian nuclear deal, Jonathan. That could potentially mean more barrels pretty immediately on the market to quell some of this. The other option, of course, is they were talking about a gas tax holiday at one point in the Congress. The issue with that is what president is going to want to then put that tax back on. It's incredibly difficult to try to mitigate these issues when this is a global marketplace when it comes to crude oil.
Anne-Marie, thank you. Down in D.C., as ever, AMH crude. 108 on WTI. We're back away from session highs on Brent to 110.90 after coming very close to 114 on Brent a little bit earlier this morning. Chairman Powell coming up a little bit later on Capitol Hill at the top of the hour. The quote from him looks like this: with inflation well above 2% and a strong labour market, we expect it will be appropriate to raise the target rate for the federal funds rate at our next meeting later this month. Mike McKee setting the stage for that rate hike in a couple of weeks.
Yeah, there's not a lot of bipartisan agreement in Washington, but Governor Reynolds and the president would probably both agree with the Fed chair's assertion that they're going to start raising interest rates. They need to do something about inflation, although in his prepared remarks, Jay Powell is still sticking with the transitory story, even though he doesn't come close to using the word. Here's what he says. We continue to expect inflation to decline over the course of the year as supply constraints ease and demand moderates because of the waning effects of fiscal support and the removal of monetary policy accommodation. But, he says, they are attentive to the risks that it still continues to rise, saying they'll use their policy tools as appropriate to prevent higher inflation from becoming entrenched while promoting a sustainable expansion and strong labor market. Now, he assesses the economy as in pretty good shape right now. The rapid spread of the Omicron variant led to a slowdown in January, but that seems to have proved temporary, and we're going back up again. The labor market is strong, extremely tight, he says. Companies can't find workers, people are quitting their jobs, and wages are rising. And, as he admits, they're well above their target on inflation. The one wild card he does admit to is Ukraine, saying of the Russian invasion, the near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war, the sanctions and the events to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition the economy evolves in unexpected ways. So you can expect more questions about Ukraine, John, from members of the committee. They'll try to drag him into who's at fault on inflation, and he'll try to avoid that.
I imagine he'll try and stick to the script and try and make this boring too. Mike McKee, this moment, anything but boring, depressing in many ways as well. Equity session highs up more than 1% on the S&P and the Nasdaq up by 0.75% with your sector price action. Here's Abby.
John, we are looking at a fairly robust rally. All 11 S&P 500 sectors are higher, not surprisingly led once again by energy as oil continues to surge right now at 2013 levels. Financials also popping, a recovery there with yields up on those Fed Chair Jay Powell remarks. But you can see, again, all 11 sectors are higher, including discretionary, tech. So investors want back in. We are buying the dip, at least today, at least this morning. As for the last 5 days, and let's see what the effect really is of the Russia-Ukraine war, you can see energy really the top sector, up more than 8%. Metals and mining, though, too. That's that natural resources story on the supply shortage, supply fears. And then banks with yields being going down as bonds are bid, excuse me. You can see financials and the KBW Bank Index over the last 5 days down sharply. All this can change any moment. Volatility, the name of the game. But
of course.
Yes.
Session highs right now, at least. That's for sure. Up almost 1% on the S&P. Abby, thank you. As always, your trading diary up next. Twenty-6 minutes in, equities up 1% on the S&P, yields climbing too. Chairman Powell just moments away. Here's the trading diary. Chairman Powell testifying on Capitol Hill at the top of the hour. Then President Biden discussing infrastructure a little bit later, 3:15 this afternoon. Another round of jobless claims coming tomorrow morning, plus more Fed speak. Barkin, Williams, Chair Powell heading back to the Hill for a second day of testimony. And we round out the week with the payrolls report in America. The estimate right now, the median estimate, about 403,000. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.